Central banks are crucial in shaping monetary policy and ensuring financial stability. They manage interest rates, control inflation, and regulate the money supply. By doing so, they influence economic growth, employment, and the overall health of the financial system. Their decisions impact everything from mortgage rates to the cost of goods and services. Central banks are the backbone of modern economies, influencing financial markets and daily life. Their core mandates include controlling inflation, managing interest rates, and ensuring financial stability. By regulating money supply and acting as lenders of last resort, they maintain economic equilibrium and confidence in the financial system. Central banks are pivotal institutions managing monetary policy, ensuring financial stability, and issuing currency. Notable examples include the Federal Reserve, European Central Bank, Bank of England, and Bank of Japan. They operate independently from governments, yet uphold democratic accountability through transparent communication and reporting. Central banks ensure price stability by controlling inflation through precise monetary policy. They manage interest rates to influence economic activity and maintain stability. As lenders of last resort, they prevent systemic collapse during financial crises. Additionally, they regulate and supervise financial institutions to ensure sound banking practices and protect consumers. Central banks, as guardians of economic stability, play a pivotal role in shaping global financial markets. Their decisions impact the economic well-being of billions, ensuring stability through strategic interventions. These institutions are crucial in maintaining economic equilibrium, influencing both domestic and international financial landscapes. Central banks utilize tools like open market operations, reserve requirements, and discount rates to steer economic conditions. These mechanisms adjust money supply and influence interest rates, aiming for price stability and full employment. By buying or selling government securities, they manage liquidity, impacting borrowing costs and economic activity. Central banks set benchmark rates to influence borrowing costs, consumer spending, and business investments. Most major banks aim for a 2% inflation target to ensure price stability and support growth. In 2025, the European Central Bank and Federal Reserve are easing rates after aggressive tightening to address post-pandemic inflation challenges. Quantitative easing involves large-scale asset purchases to inject liquidity during crises. The Federal Reserve faces £230 billion in losses since 2022 due to interest rate risks from past quantitative easing programs. Globally, central banks are now shrinking balance sheets and revitalizing interbank markets as economies stabilize. Central banks traditionally use interbank markets to set short-term rates, leveraging market forces for optimal pricing. The Federal Reserve, however, opts for government-controlled rate setting, reducing private sector involvement. This approach risks stifling market expertise and heightens taxpayer exposure to interest rate volatility and potential losses. Central banks face the challenge of balancing domestic stability with global economic interconnections. They must adapt to international dynamics, such as fluctuating exchange rates and cross-border capital flows, while ensuring effective monetary policy. This requires a nuanced understanding of both local and global economic conditions to maintain financial stability and foster economic growth. Emerging markets' central banks evolved significantly since the late 1990s, adopting inflation targeting and gaining independence. However, policy effectiveness is hindered by global financial conditions and reliance on external financing. The 2025 trade tensions, with rising tariffs and disputes, further challenge monetary policy effectiveness in these economies. Trade disruptions have led to tariffs at century-high levels, affecting global growth and inflation. Central banks are navigating this by balancing growth support with inflation control amidst geopolitical risks. Their monetary policy frameworks now stress predictability and flexibility to manage unprecedented uncertainty. Central banks are navigating a landscape of uncertainty, balancing stability with the need to adapt to shifting global trade dynamics and economic pressures. This involves recalibrating monetary policies to address unpredictable trade relationships and economic challenges, ensuring resilience in the face of global disruptions. Central banks are pivotal in ensuring international monetary stability by managing currency values and fostering global trade. They collaborate to set exchange rates, influence interest rates, and provide liquidity. This cooperation is essential for mitigating economic shocks and maintaining confidence in the global financial system. The United States dollar maintains its dominance in global reserves, overshadowing the euro, Japanese yen, British pound, and Chinese renminbi. Despite geopolitical tensions, the dollar's stability and widespread acceptance ensure its continued supremacy, while other currencies face challenges in gaining similar international trust and influence. Central banks are increasingly exploring digital currencies to modernize payment systems and improve monetary policy. The Bank for International Settlements 2025 report identifies tokenization and stablecoins as pivotal trends in digital finance. However, challenges like maintaining public trust, ensuring cybersecurity, and establishing robust regulatory frameworks are crucial to successful implementation. Central banks face the dual challenge of adapting to technological advancements and maintaining monetary stability. They must innovate to manage digital currencies and address cybersecurity threats while ensuring effective regulatory frameworks. Balancing these demands is crucial to preserving their role as monetary guardians in an evolving financial landscape. Central banks in 2025 aim for neutral interest rates to balance inflation and growth without overstimulation. Rapid rate adjustments risk destabilizing inflation expectations or growth. Transparency and democratic accountability are crucial to uphold public trust in these monetary policies. Artificial intelligence, deglobalization, and financial innovation are reshaping monetary policy. Central banks require robust frameworks to navigate uncertainty and structural shifts. A hybrid approach, combining data-driven, rule-based frameworks with human discretion, is essential for effective policymaking in this evolving landscape. Central banks are innovating with digital currencies, aiming to enhance transaction efficiency while maintaining financial stability. These new forms of money leverage blockchain technology to ensure security and trust. As these systems evolve, balancing innovation with regulatory oversight becomes crucial to prevent systemic risks and ensure public confidence in the monetary system. The Federal Reserve's approach emphasizes government-controlled, short-term rate setting, diverging from private interbank market mechanisms. This strategy has led to significant operating losses, over £230 billion, due to interest rate risk from quantitative easing. The ongoing debate centers on balancing market efficiency with necessary government control in monetary policy. The European Central Bank's 2025 strategy involves reducing rates from 4.00% to 3.25%, aiming for a 2% inflation target. This approach emphasizes medium-term goals and clear communication with markets. The focus is on achieving a soft economic landing, addressing slow growth and gradual inflation reduction in the Eurozone. Central bank balance sheets expanded dramatically during the COVID-19 pandemic due to quantitative easing. This expansion impacted liquidity, credit availability, and market stability. As we approach 2025, a gradual normalization is underway, aiming to stabilize these factors while maintaining economic resilience. Central banks are navigating a pivotal era, balancing the need for bold innovation with the imperative to maintain trust and stability. This dual focus is crucial as they adapt to unprecedented challenges, ensuring they remain the bedrock of modern economies while embracing necessary transformations. Central banks are crucial for economic stability, navigating global uncertainty and technological change. They must embrace innovations like central bank digital currencies, balancing risks and public trust. Transparent, adaptive policy frameworks will define future monetary governance, balancing tradition with transformation to serve global economies effectively.